Well, the stock market's been putting on quite a show this year, hasn't it? I mean, record-breaking highs, and everybody's talking about AI. It's captivating stuff.
It is.
But with the S&P 500 already up over 20% since January, it's got a lot of people wondering, is this bull market about to hit a wall? And that's our deep dive today, using this recent Motley Fool article as our guide. They call it, the S&P 500 just did something for the first time this century. Which, let's be honest, that's expert-level clickbait.
Yeah, it certainly grabs your attention.
It does.
And what they're referring to is that 20.8% year-to-date gain. You mentioned the highest for the S&P 500 at this point in the year since, get this, 1997.
1997, back when we were all listening to the Spice Girls and dial-up internet was blowing our minds. But I'm guessing those market gains weren't fueled by AI stocks like they are now, right?
You're right. It's a whole different landscape.
Yeah.
This time around, we've got the Magnificent Seven leading the charge. Apple, Microsoft, Amazon, Alphabet, Meta, Nvidia, and Tesla.
Right?
Together, they've contributed to almost half of the S&P 500's growth, with Nvidia alone accounting for nearly a quarter of those gains.
Wow, Nvidia, the darling of the AI boom. It's like they cracked some kind of code and everybody else is just trying to catch up. But here's where it gets really interesting. The article points out that this is the first time in the 21st century that the S&P 500 has surged this much in the first 3 quarters. So we're in uncharted territory here.
Right.
Which begs the question, what can we learn from the past, if anything, to help us understand where things might go from here?
That's the million-dollar question, isn't it? The article digs into historical data and finds that since 1957, there have only been 7 other years where the S&P 500 saw gains of at least 20% in the first 3 quarters.
Okay.
Now, what's key isn't just that it's happened before, but why it happened. Were those periods also driven by, groundbreaking new tech, or were other economic forces at play?
Okay, so let's unpack those historical parallels a bit. The article mentions a median return of 31% during those years, which sounds promising on the surface.
Right.
But of course, we can't just extrapolate from the past and assume we're on track for similar growth this year, can we?
Exactly. While history can be a guide, it's not a guarantee.
Right.
The market doesn't move in predictable cycles. It's more like a living, breathing organism constantly reacting to new information, economic data, and importantly, investor sentiment.
Speaking of investor sentiment, the article mentions the American Association of Individual Investors, AAI, sentiment survey. Can you tell us a bit more about how that survey works and what it's telling us right now?
Sure. Every week, the AAII polls its members, who are individual investors like you, asking them whether they feel bullish, bearish, or neutral about the stock market over the next 6 months.
Okay.
It's a straightforward way to gauge the mood on the street, so to speak. And right now, while the overall sentiment remains bullish, we've seen a recent uptick in bearish sentiment.
So some investors are starting to feel a bit wary, even with these record highs. Is it just a case of what goes up must come down thinking, or are there more concrete factors driving that shift in sentiment?
It's probably a mix of both. Human psychology plays a big role in investing.
Right.
When a bull market runs for an extended period like this one has, it's natural for some investors to start getting nervous about a potential downturn.
Yeah.
And that brings us to another crucial piece of the puzzle: valuations.
Right. Those price tags attached to stocks can sometimes feel a little out of sync with reality. The article flags the S&P 500's price-to-earnings ratio, or PE ratio, as being above its 5-year and 10-year averages.
Sure.
For those who might not be familiar, what exactly does that tell us, and why is it a potential concern?
Good point. Let's break that down in simple terms. The PE ratio tells you how much investors are willing to pay for every dollar of a company's earnings.
Okay.
A higher PE ratio suggests investors are optimistic about future growth and willing to pay a premium for those earnings. However, when the PE ratio gets too high, it can indicate that stocks are overvalued, meaning they're priced higher than their underlying fundamentals might justify.
Like that classic case of the emperor's new clothes. Everyone's raving about how amazing something is until somebody points out that, well, there's not actually anything there. So are we in danger of a similar scenario with the stock market right now?
That's the big question, and it's not an easy one to answer. We're seeing some warning signs like those elevated PE ratios and a shift in investor sentiment, but there are also factors that could keep this bull market running.
Okay.
One thing the article highlights is the upcoming economic data releases in October.
Right.
These reports on things like inflation, retail sales, and job growth will give us a clearer picture of the health of the economy. Strong data could fuel further optimism, while weak data could spook investors and potentially trigger a correction.
So it's like we're all holding our breath, waiting to see which way the wind will blow.
Yeah,
And to add to that uncertainty, the article mentions Wall Street analysts are offering kind of a mixed bag of predictions for where the S&P 500 might end up by the end of the year.
exactly. We've got some analysts forecasting continued growth, while others are predicting a pullback.
Mm-hmm.
Interestingly, the median year-end target for the S&P 500, as per the article, is around 5,600.
Which would actually mean a slight dip from where we are now that seems to line up with those whispers of caution we're hearing.
Right, and it speaks to the importance of not getting caught up in the hype of the moment, whether it's fear of missing out or fear of a crash. Letting emotions dictate your investment decisions rarely ends well.
So with all these conflicting signals and potential scenarios swirling around, how can our listeners make sense of it all and, more importantly, avoid making impulsive moves they might regret later? So how do we tune out all that noise and just focus on what really matters when it comes to navigating a market like this?
It really boils down to something we touched on before, adopting a long-term perspective and focusing on the fundamentals instead of trying to time the market.
Right.
Or chase short-term gains. Shift your attention to understanding the businesses behind the stocks. What are their competitive advantages? Are they innovating and adapting to changing market conditions? Do their valuations make sense based on their growth potential, not just on today's hype?
Yeah, it's like that famous saying, time in the market beats timing the market. But that's easier said than done right. Especially when you're just bombarded with all this news and opinions about every little market blip.
Absolutely, and that's where having a sound investment philosophy comes in.
Okay.
Whether you're drawn to value investing, growth investing, or something in between, define your strategy and stick to it. Think of it as your investing compass guiding you through the inevitable ups and downs of the market.
So don't panic if the market takes a dip.
Exactly.
Don't get swept up in the euphoria if it continues to surge. Stay focused on those long-term goals and your well-researched plan.
Precisely. And remember, investing should be a journey of learning and discovery. The more you understand about the companies you invest in, the more confident you'll be in your decisions, regardless of what the market throws your way.
You know, that's a great point to wrap up on. We've covered a lot of ground in this deep dive, from that historical context of bull markets to the potential headwinds on the horizon. We talked about investor sentiment, those eye-catching valuations, and the crucial role of economic data. But ultimately, the key takeaway here is that while no one can predict the future of the stock market, understanding the forces at play and sticking to a well-defined strategy will always be your best bet.
Well said. And if this discussion has sparked your curiosity, I encourage you to keep exploring. Dig deeper into those magnificent 7 companies we talked about. Look beyond the headlines and delve into the economic indicators that drive market sentiment. The more informed you are, the better equipped you'll be to navigate the complexities and the opportunities of the stock market.
Now that's a thought-provoking note to end on. Thanks for joining us for another deep dive. Until next time, happy investing, everyone.